Hello, everyone. Yeah, welcome to the webinar. Post-pandemic growth is co-hosted by PEM Corporate Finance and Foresight. So thank you for taking the time out of your busy schedule to join us today. Before we kick off with the presentations, just a few housekeeping points to note. The webinar will finish at 1 p.m. and we will keep to time. Secondly, just to save you the effort of scribbling down notes, we'll be recording this session and we'll be providing a summary of the presentations after the event. You'll notice that there's a Q&A box at the bottom of your Zoom of the screen of the Zoom toolbar. Please use that if any questions come to mind during the webinar. There'll be a Q&A session at the end of the presentations. All of our speakers will be ready and willing to answer those questions, so once those presentations are completed. Just a quick overview of who we've got on the roster today. So we've got Philip Olagunju, who's partner at PEM Corporate Finance. He's providing us an economic update, as well as a few other sort of CF-related topics. Charles O'Riordan joins us from Foresight. He'll be focusing on raising finance and maximising cash flow. And finally, Jan Fachot heads up the business tax team at PEM. He'll be talking about tax rate rises, and incentives for businesses. So as noted, Q&As at the end. So please use that Q&A box at the end, at the bottom of your screen. So without further ado, it will be over to Philip now to get us underway.
Thank you, Shaun. Good morning, everyone. My name is Philip Olagunju and I'm Head of Corporate Finance at PEM Corporate Finance. And today I'll be covering off an economic update for the UK, what some of the resultant implications are for business, and some key growth strategies for businesses in this post-pandemic world we're currently in. Now, talking of the pandemic, I do love this picture. I recycle it as often as I can do. Foresight and PEM Corporate Finance last did a joint webinar in May 2020. And if you cast your minds back to just over 2 years ago, masks and toilet roll shortages were very much front of mind for most of us. However, a lot has happened since then and the world has undoubtedly changed. But I think it's fair to say we anticipated plenty of economic challenges over the period, but actually the UK has grown beyond pre-pandemic levels, as evidenced by what's happening in the labour market, which remains frothy. Unemployment has dropped below 4%, with recruitment remaining an issue across multiple sectors, and I'll touch upon that later on in the presentation. The chart on the right-hand side here, produced by PwC, shows the increase in the number of vacancies per 100 employee jobs by sector. So there's a general increase across all sectors listed. You can see the yellow to red bars going towards the right-hand side. And that's across the range of professional services, transport, construction. And interestingly enough, the largest increase is in accommodation and food service activities. It just goes to show, really. However, and I'm going to use the I word now, and this is widespread information, inflation is a huge issue, and it's set to hit a 40-year high. It's mainly imported inflation driven by the Eastern European conflict, lockdowns in China, which are halting production processes. And we've all no doubt heard the doom and gloom around rising household energy costs to the tune of about 54% when I last checked. And unsurprisingly, consumer confidence has been a bit like me in a ring with Anthony Joshua. It's taken an absolute beating. The chart here shows consumer price inflation year on year from circa 1989 to present day. And you can see it's quite clear, a significant increase in the index from circa 2020 onwards. So whilst the UK economy has been growing, this growth is undoubtedly slowing down, right? The chart here again produced by PwC, shows 2022 GDP growth predictions from various institutions such as the Bank of England, the Organisation for Economic Cooperation and Development, and the Office for Budgetary Responsibility. And there was previously a consensus of around circa 4.5% GDP growth. But following the invasion of Ukraine, higher commodity prices, slower household consumption, and lower real earnings, growth projections have obviously been revised downwards to circa 2.8 to 3.8%. So it's a bit of a mixed story, really. And what are some of the real implications for business? Well, first of all, you may be surprised to hear that corporates remain optimistic about future prospects. Deloitte carried out a survey interviewing many CFOs of sort of medium-sized to larger enterprises. And across the board, 75% of them expect their company's revenue to grow in 12 months' time. Whilst they appreciate that operating costs will rise and margins will be squeezed, expansion plans remain in situ, and CapEx, capital expenditure, remains a priority, as indicated by this chart, which shows a high percentage of CFOs, chief financial officers, still intend to prioritize CapEx over the next year or so. So notwithstanding, there are several opportunities and challenges ahead for businesses and business owners. There's still a disproportionate level of cash sloshing about compared to pre-pandemic levels, both in terms of households and businesses, to the tune of 140 billion for businesses. It's an astonishing amount of money. We're seeing sectors most impacted by COVID-19, such as hospitality, leisure, travel, making a strong comeback. And actually, in terms of travel, we've obviously heard some of the issues that TUI have had. I think that's just demand outstripping the availability of staff, really. So just shows you what a strong comeback that industry has made. We're expecting tax receipts to increase, and my colleague Jan later on will pick up upon tax implications and what that means for business and for growth. The key implication for businesses remains global supply chain disruptions, right? And the chart here on the right-hand side, it's quite a clever chart. It shows an index for suppliers' delivery times, currently at the slowest point across the last 20 years when looking across a range of sectors. And that chart's been pulled together by JP Morgan and S&P Global Market Intelligence. So against this backdrop of slowing economic growth, rising inflation, frothy labour market, and ongoing supply chain issues, what are some post-pandemic growth strategies for businesses to adopt? The first, and in my opinion, probably the most critical strategy, is around staff retention. I was at an economic update event recently hosted by Sir John Cunliffe, who's the Deputy Governor for the Bank of England. And the general consensus across a range of sectors represented in that particular room was that recruitment remains a huge problem, right? There are vacancies, there are opportunities for jobs to be filled, but they're just not the level of candidates out there available in the market. And underpinning this is the concept phenomenon of the Great Resignation, where an increased cost of living, coupled with job dissatisfaction, coupled with poor remote working policies, have led to workers to basically vote with their feet and quit, only not to be replaced. So underpinning this is this Great Resignation phenomenon. So it's really about retaining staff through creating purpose-driven environments which boost employee engagement, which boosts employee retention, which drives growth, right? Okay, and I guess the next key strategy is around digital transformation. Accelerated by the pandemic, a range of traditional business functions have been modernized in pursuit of competitive advantage, whether that's sales, marketing, production, HR, finance, manufacturing, whatever it might be. Further advantages can be achieved through the adoption of the artificial intelligence, robotics, cloud computing, etc. But careful care and attention needs to be taken when considering the impact of some of these digital transformation strategies, particularly around automation and quote unquote the replacement of human beings. Cybersecurity remains a key risk, and also ethics as well is key for business leaders to consider when implementing and adopting some of these strategies. And finally, around post-pandemic growth strategies, we're hearing a lot more about environmental, social, and governance issues and how these can be utilized to pursue growth. And a recent survey by Bain & Co revealed that 65% of M&A professionals expect businesses to shift their perspectives towards ESG, and this further kind of emphasizes its importance. Regulators, customers, employees have all turned their gaze towards ESG, as have investors. And Charlie will touch upon some of this during his presentation shortly to follow mine. So essentially, a focus on ESG will result in improved brand association, in some cases lower costs of capital, and efficient cost management, all underpinned by sustainability. And that has to be a key consideration for business leaders when thinking about growth in this post-pandemic world that we're currently occupying. So lots and lots to consider in terms of the economy and in terms of growth. Hopefully you found that interesting. I'll now hand over to Charlie, who will cover off best business practice for raising equity and debt funding, and amongst other things. Over to you, Charlie.
Thanks very much, Phil. Just 2 seconds while I get my slides up. Where have they gone? I think that's the one. Hold on. Hi, everybody. Hopefully that's come up on your screen. So what I'm going to be talking about today is, firstly, raising finance and the availability of financing across sort of a range of asset classes. And we're sort of raising finance to do a number of things, and sort of keeping on topic to this webinar, it's really about post-pandemic growth strategies, how businesses are looking to sort of achieve the next phase of growth in their business, having weathered 2 years of extremely difficult trading and macroeconomic environments, and now using this opportunity to really capitalize on the resilience that businesses have demonstrated over the last couple of years. And more generally, in the latter part of my sort of discussion, is thinking about actually what can businesses do better individually to consider their own cash flow circumstances. And I think, certainly COVID has taught a lot of people some very, very lean business operating practices, but there's always new things to be explored, which we'll touch on. And if we do rattle through anything more too quickly, the PEM team will be more than happy to share the slides with you. So first of all, I think it's well worth touching on the availability of funding. And to Philip's comment earlier, we were in a position whereby a lot of businesses are sitting on some relatively inexpensive funding, having fully drawn C-bills, bounce back loans, CL bills, etc. But if we look at where we stand today, with the government looking to increase the Bank of England base rates, I think the expectation is now 25 basis points quarter on quarter until the end of 2024, which could get us to about 3% base rate by the end of that year. And sort of hand in hand with that, it's worth also considering what are banks' appetite to lend. I think when we're looking at the macroeconomic uncertainty that Philip touched upon, a lot of inflation, wondering about how supply chains are going to unwind post-COVID, and China sort of switches their manufacturing on back to full capacity, and shipping is also switched on to deal with that. What does that mean for businesses and for banks' appetite to lend on both secured and unsecured facilities? And conversations that I'm having at the moment is banks are interested in lending. There is some competition for the higher quality assets, but for the most part, it feels like banks are looking to support their existing customers rather than new ones. And what does that mean for business owners with regards to sort of thinking about their next steps? My recommendation would be have those conversations with your banks now, before certainly credit markets from the high street lenders become a bit tighter. Looking at the public markets, I think it's quite easy to be quite shocked about how quickly certain of the tech stocks have fallen. And part of that is symptomatic of overfunding by some venture capital firms. Very buoyant market over the last couple of years with regards to digital products. But looking at the Nasdaq over the last 6 months, the tech index has fallen something like 20 to 25%. But that isn't necessarily reflective of the wider economy at whole, particularly among more stable, well-established industries such as such as manufacturing, finance, and the sort of places where we see, great businesses, particularly across the east of England. And the FTSE 100, and I appreciate, that's global finance and industrials, but nevertheless, actually, I think it's down maybe 0.5% or less over the same period. So the public markets, while sector by sector have shown a lot of volatility, actually, if we look across the broader landscape, the majority of businesses appear relatively unaffected, although I appreciate that may not be reflected in everyone's stocks and shares ISAs at the moment. The other thing to note for people raising funding is that private equity and debt markets don't necessarily reflect the public mood. And certainly, as I'll get on to the next slide, private equity investors have more capital than ever to invest. And private debt are in a similar position. And if we look at second tier banks such as Oak North, Shawbrook, Triple Point, Bricoa, among others, they're similarly sitting on large amounts of capital they're very keen to deploy into the right, interesting business. Very quickly touching on private equity markets, it's been the case for a while in a low interest rate environment that private equity houses have been very successful in raising money. Individual and institutional investors have been very keen to generate returns outside of sort of stock markets and general bonds. So they are sitting on billions, if not trillions, of capital globally to be invested into unlisted businesses. And throughout 2021, despite the pandemic, and I think probably caused by optimism in seeing the end of that, fundraising has continued, and articles written in the first part of this year, prior to the conflict in the Ukraine, has shown actually continued fundraising. So not only are businesses sitting on a lot of dry powder, I think investors as well, for the most part, are looking to support small businesses and large ones actually alike. What this means is for businesses raising money is that there should be a lot of competition for assets. So people will be competing to deploy that capital. They want to continue their fund's legacy. They want to raise the next fund, and they can only do that by making successful investments and showing that they can deploy their capital successfully. So I would say having a good advisor on board is key, but having a few people involved in a process to make sure that you keep your other investors, honest when looking to raise money is really important. And not only will that help with valuations, but also with regards to terms. And finally, ESG, and Philip lightly touched upon that. It is one of the top things that investors will consider beyond the financial metrics of the business. I think we're entering a world now whereby not having some form of ESG policies in place can be destructive to value, particularly when considering a trade sale, because large companies have the resource and the ambition and the requirement put on them by their suppliers and customers to meaningfully adopt ESG strategies. And if you want to be bought into one of those groups, both from an investor and a sort of large corporate perspective, they don't want to see you diluting the good work that they've done. And it's important to note that among the stakeholders that Philip mentioned earlier in his discussion, supply chain up and down are now participating in sort of forcing ESG agendas through businesses. I've recently made an investment who supplies blue chip house builders. The blue chip house builder is a real living wage employer, and they're insisting that people who supply to them are now also real living wage employers. So those sort of strategies, admittedly, do have cost implications, but back to the sort of Great Resignation, they also have implications for retaining your workforce, and staff churn is something that you really don't want to be getting into. The efficiencies that can lead to, can be very dampening for businesses growth aspirations. So when looking to raise financing, where are you looking and who are you looking from, and what type of investments is that going to look like? So debt typically will look to lend to established businesses, either being repaid through regular cash flow repayments on an unsecured loan, or by taking security or collateral over tangible assets. Touching initially on sort of secured loans, hopefully that should be quite clear to the majority of people. A mortgage on your property is a classic example of that. You've got a tangible asset, and ultimately, if the loan isn't repaid, the bank can foreclose on that asset and seek repayment through the sale of that asset. Typically, those can be used to acquire property or capital equipment, being the obvious one, but also asset-based lending and stock financing. For example, if you have large outstanding receivables from customers, you can actually refinance those with a bank, and the bank will then start to reclaim those receivables on your behalf, charging you some interest for that pleasure. What that means is, if you do have a large working capital cycle, particularly with short payables and long receivables, it's a great way to free up cash to be put to other uses, particularly growth at the moment in the context of this wider webinar. Unsecured loans is now something that a lot of business owners have sort of come across, C-bills and bounce back loans being the obvious ones, whereby that loan really has no collateral apart from the personal guarantees that business owners were, in my view, wrongly required to put forward. And now businesses are looking to repay those loans from free cash flows. There's a lot higher risk, obviously, because there's very little physical collateral to come after, and they're typically deployed over a shorter term, so sort of 5 years is often the maximum. Having an overdraft in place, talking of sort of banks' willingness to lend at the moment, is actually not a bad idea to consider at present, thinking about short-term funding of day-to-day emergency expenses, but those can be a little bit more expensive than a term loan, so it's worth just bearing that in mind in regards to sort of wider sort of financing structure. Equity is always an interesting conversation to be had with small and medium-sized business owners. In a lot of regions across the UK, there is a very buoyant sort of equity for capital for equity market, particularly in startups. But just because you're operating a large, established, profitable business, that doesn't mean that there isn't an equity for cash transaction to be had. And that cash going into a business can be used either for growth, or if a business owner is actually just looking to realize some value and take some cash out of the business. So with my own hat on, private equity is something which I have spent a lot of my career covering. And private equity investors are looking to invest in well-established businesses with a good product and a great management team, with a view to working towards a full exit in 3 to 5 years' time. Now, what does all of that mean? Bearing in mind the last couple of years when it's been hard for people to demonstrate their business, sustainable long-term growth. I think what one's looking for is a credible growth plan going forward, a management team who have been dynamic and very proactive in dealing with the issues that have come across during COVID. Industry-leading products, I think that's characterised by a high gross margin, to be honest. It's very, very difficult to sort of know exactly what a great industry-leading product looks like, but if you can charge a premium versus your competitors and customers are willing to pay for that, I think that is a good demonstration of your product being very differentiated and that it's worth chasing larger market share for a growth plan. Venture capital, on the other hand, is looking to invest in businesses at perhaps very early stage. You're at a nuanced, you're just sort of inception of an idea, or you've brought that idea to the market, customers are starting to show some traction, and investors are looking to support the further growth of that strategy. I mean, ultimately, every fund will have their own investment strategy and thesis. And when you hear about stories of businesses that have been both successful and unsuccessful in the markets, having been operating in this world for a few years now, you realize just how many funds there are and just how different they all are. At Foresight, we like to think we've got a fund for everything, but nevertheless, there are still opportunities that we're not able to finance. And what we like to try and do is pass those around to other people. So if you are raising capital, either for the debt or the equity markets, it's worth, again, speaking to a good advisor and ensuring that you really do a full market search, because there's usually a home for every business somewhere, particularly if it's showing a lot of the things that I initially covered on: good management team, a USP, a credible growth plan, and some sort of future either exit for private equity or meaningful profitability for venture. So just very quickly to touch on maximising cash flow. it's a very there are a lot of options available in the toolkit to businesses to do this, and I would say the two leading things to do. Number one is maintaining a cash flow forecast. It's not necessarily easy for every business owner to do. It can require a little bit of additional resource, additional time. But at the moment, when people are looking at inflationary pressure on businesses, their profitability, the credit worthiness of their supply chain, being able to identify where your risks lie, what if a customer doesn't pay, what if your costs go up, what if your key customer suddenly goes under, you're able to see that before it happens so you can take action or be prepared to take action. The other one is the learnings from COVID-19. It goes without saying that almost every business that anyone can speak to found their revenue materially impacted by the lockdowns that were imposed in March 2020. And as a result, the businesses that have managed to demonstrate resilience through that period were the ones that were quickly speaking to their customers, their suppliers, and importantly, their advisors across the board to foster those relationships both up and down the supply chain, work by sharing some of the cost of that, of the cash flow pressure that people were incurring. And now in the inflation environment that Philip touched upon, sharing those cost increases. Don't be afraid to put some transparency in your costs and your prices to your customers and suppliers so that you can say, this is just some additional surplus we're putting on. When the cost is taken off us, we'll take it off you. And I think there's a lot to be said now at the moment, and we're talking to our businesses in great detail about how we can be almost the first to reduce prices, like petrol, up like a rocket, down like a feather. But if we can demonstrate to our customers and suppliers that actually, do you know what, costs have fallen, we'll be the first to reduce our prices, I think it sends a fantastic message to the market that you're not being the ones that are profiteering. And I think that should go a long way with regards to sort of building your brand and your reputation in the market. Obvious ones, your working capital cycle. How long does it take to collect cash from your customers versus paying out to your suppliers? A lot of businesses are extremely profitable, have a great product and are very successful, but aren't really aware of what the cash squeeze that can cause a business if you're paying out to your staff or customers quicker than you're able to collect from your customers. Credit worthiness, I think we've covered. Direct-to-consumer businesses are going to be under pressure in the next few years. As Philip mentioned, inflation reaching sort of 40-year highs, touching on sort of 7-8%. So if you're in the consumer sector and you don't have sort of well-defined product niche or sector, if you're even supplying to those businesses, you need to be thinking about actually, is there a long-term future for this product being sold to this customer? Or I do need to think about reconsidering what my product offering is or who my customers are. On the flip side, if you're supplying to the NHS or to the government doing infrastructural healthcare work, you can be relatively confident that that work's going to continue with HS2, the Elizabeth line now finishing, and various other large projects across the country. An interesting one which I came across as part of researching for this webinar was moving on unsold stock. I think it's very easy for businesses to be sat on things which they may be forced to sell at a slight loss. But if you are in a tight cash flow position and these items in your inventory are not your hero products, they're not really driving forward your business, they're not really creating additional market share, why not just offload them and free up that cash for actually what will be a more profitable, meaningful growth investment? And as I mentioned, it's the learnings from COVID-19. And I think to Phil's point, which he touched at the very beginning, business owners are incredibly buoyant about what the next 6 to 12 months look like, despite everything that's going on in the market around them. So it's an opportunity to use the relationships that have been built over the sort of 2-year COVID period and really apply that into both the inflationary period that businesses are going into, particularly in manufacturing sectors where businesses are impacted by light and heat, rising cost of wages, etc., and share the pain throughout the supply chain and try and minimize the impact on your margins and therefore and understand the cash flow positions of your customers and suppliers as well, so that you can be quick to react. And I think that's the thing, it's being constantly in dialogue with the key stakeholders of your business is what should hopefully lead to a smoother journey if things do become more difficult. That's it from me. Lots of capital in the market, lots of opportunity for businesses to capitalize on the next sort of 12 to 18 months. But it goes without saying that I don't think it's going to be straightforward. So thanks very much for listening, and I'll pass over to Jan.
Jan, you're on mute.
Oh, thank you very much. Thank you, Charlie. By way of introduction, Jan Fachot, part of the PEM business tax team. So today I've been left with the final bit on taxation. So hopefully plenty of interesting topics. So the three areas I'm going to be looking at are managing tax rate rises. There's quite a few on the horizon. We've already seen some coming in this year, and we are expecting to see some more next year. We are also then going to cover what we can do in the short, medium term for businesses, and really to manage the tax position, and ultimately looking at the longer term position, what you can do as a business owner when you're ultimately deciding to exit the business. So again, as part of doing the research for this webinar, I was having a quick look at a report from the Institute of Fiscal Studies, which was published at the end of last year. And I think they were saying that UK tax revenues are forecast to reach their highest level, sustained level since World War II. And the forecast for 21-22 in terms of tax revenues is 732 billion, which is equivalent to 32.3% of GDP. And this is slightly lower than the average that has been the case since 2000-2001, which has been 33.1%. And this decrease has really been primarily as a result of the fall in tax revenues caused by COVID-19 pandemic. However, because of tax rate rises and inflation, this is forecast to rise above 35% of GDP, which would be the highest sustained level of taxation seen in the UK since World War II. I think last time we had 35.1%, it was in the early 1960s. And that study was carried out at the end of last year, and that was well before we had the conflict in Ukraine and rising inflation. So I expect that the tax revenues will increase as a result of inflation, which I'll go into a bit more detail. So I think the big one that everyone is aware of is corporation tax. And actually in the Times this morning, I think there's quite a lot of pressure on Boris Johnson and Rishi Sunak to reverse these changes. We've had a very low rate of corporation tax of 19%, and that is set to end as of 31st of March 2023. And it's going to jump to 25%. And that jump is a 31.5% jump in the rate of corporation tax. And that applies to companies with taxable profits over 250,000. We're still going to have a small profit rate for companies with taxable profits, which are up to £50,000. Now, between £50,000 and £250,000, actually, there's a marginal rate of 26.5%. And that is even a higher jump when comparing to 19%. And we're talking about 39.5% jump in the tax rate. So certainly between that 50,000 and 250,000 taxable profit band, you certainly need to manage your tax position as a company carefully. Those thresholds also have to be looked at in terms of short accounting periods, and also there is the return of the associated company. So if you've got one company controlling another, or two companies being controlled by the same shareholder or shareholders, then those thresholds of 250,000 and 50,000 have to be divided. Other increases we've seen are, in terms of corporation tax, generally the UK has had the lowest rate in the G20. So we were currently at 19%. With the increase to 25%, we are still going to be the lowest in the G7. So you can see we've got Japan, where the rate is in excess of 30%, and Germany's 30%. And we've also got Australia, the US, who've got much higher rates than the UK. In terms of other rate rises, what we've seen is we've seen the NIC increase of 1.25% from this April, and that is set to continue. Now, companies do get a deduction for NIC, so I think taking into account the corporation tax relief, we're talking about 1% NIC increase, but it's still a significant increase when looking at people within the business. We are also expecting the national minimum wage to increase from £8.91 when that was introduced. That was above inflation, but that's certainly been outstripped, and certainly there's going to be increases in the national minimum wage on the horizon. But I think really the big impact and reason we've seen a really significant increase in tax is the impact of fiscal drag. And in other words, fiscal drag is the impact of tax thresholds not keeping up with inflation. And actually, I was doing a bit of calculations, and I had a look at rates. So I looked at the rates back in 2012-13, and they are in the first column. I've adjusted them for inflation, and that would be inflation up to, I think, February, March. And then compare them to the current rates that we have. So for personal allowances and high rate thresholds, we can see that the thresholds have increased above inflation. But in terms of income tax, pensions, and other taxes, this is where the good news stops. In terms of personal allowance withdrawal, that kicks in £100,000 for every £2 that you go above that. You lose £1 of personal allowance, and actually you can see that's £20,400 should have been the increase if we were following inflation. And the same with the additional rate threshold, where you're paying 45% rate of income tax. That hasn't changed for a number of years, and if it had kept up with inflation, you should be looking at a threshold of 180,600, and this is just by keeping the rates the same. When we're looking at the impact on pensions, we've seen actually the annual allowance, lifetime allowance, and basic amounts have actually reduced. So the annual investment allowance back in 2012-13 was £50,000, it's now £40,000. So there's a significant difference. The same with the lifetime allowance. It used to be 1.5 million. It was reduced, and now it's 1,073,000. So again, we've got £733,000 shortfall in the threshold, and the basic amount where you can put into a pension without any forms of earning, £3,600. I can certainly remember that's been around for 15, 20 years, and that's remained unchanged. And again, has been keeping up with inflation. Now, in terms of capital gains tax, something that a lot of people will look at when they're looking to possibly dispose of their business. Capital gains tax has been increasing slightly below inflation. So there's a bit of a shortfall. But I think that the really big changes that we can see is back in 2012-13, we had entrepreneurs relief, which was £10 million, and that you'd get taxed at 10% on up to £10 million. And that's been reduced by to £1 million. So you can see the difference is quite significant here. And again, the same story for VAT. The VAT threshold hasn't increased for the last 3 or 4 years. So again, a lot more businesses are falling within the VAT thresholds. So really, that's the reason why tax takes are really going up quite significantly. So I think tax is really becoming quite important again on everyone's list of priorities, and it's really quite important that you do everything proactively to manage your effective tax rate. So in terms of what I'm going to cover today, I'm going to cover a bit about raising business finance and the tax implications of that, and then really all the various tax incentives you have in the short to medium term in terms of what you can do for employees, what you can do in terms of innovation, what you can do in terms of capital expenditure, and also in terms of tax losses. So we talked about financing, and that's something that's quite important when it comes to taxation. So really in the tax, we look at whether you're getting loans or equity. And loans, typically you get corporation tax deduction for interest that you pay out. And this is something that's, tax professionals will look at very closely, whether you can increase the amount of interest, especially when you have private equity, where you have connected persons. And as a result of that, there's a lot of anti-avoidance provisions that you have to be careful with. So there is the late interest rules. So effectively, if you've got a participator, typically a shareholder in a business making a loan to the company, if that interest is accrued and unpaid for a period of more than 12 months following an accounting period, then it's disallowed for tax purposes until it's actually paid. And it also applies to other connected parties. And if you're paying to non-qualifying territories, typically offshore tax havens, then the late interest rules also apply. Companies also have to think about withholding taxes, just very much like a bank. If you're paying interest, the bank typically withholds 20%. And in a lot of cases, companies have to think about the withholding tax on loan payments. And in terms of other measures to watch out for, if you're doing it within companies or private equity type structures, you have to think about transfer pricing, whether you're applying an arm's length. You're looking at thin capitalization, so looking at debt to equity. So have you got a significant amount of debt as compared to equity, which you would normally get outside of the current arrangement, and then a proportion of the interest is disallowed. And there's also the corporate interest restriction, was a very complicated set of rules which look at groups, looks at the UK interest expense and compares it over the whole group and whether an element should be disallowed. It's a very complicated area. There's a lot of anti-abuses provisions in this area. And of course, not all businesses succeed. So if the lender is a corporate lender, they'll typically get a deduction unless they're connected. And if it's an individual, they might get a relief with loans to trade relief, which is a capital loss, which they can offset against other chargeable gains. Now, in terms of equity, there's a lot of incentives from a tax perspective, and they're called venture capital schemes. And the CDIS is particularly interesting because the first couple of years of a business, any individual investors putting funds in can get 50% income tax relief. So if they invest £100,000, they get £50,000 taken off their tax bill. They also get capital gains tax exemption on growth and value of the business, and they can also defer other gains they've made if they make an investment under CDIS. And when they sell the shares after 3 years, then effectively 50% of that deferred gain doesn't come back into charge. Now, as you'd expect with such valuable tax reliefs, there are conditions on the issuing company and the types of activities it does and how it uses the money. And there are also conditions on the investors and their connections or not in terms of the business. And there are also general requirements in terms of what shares are being issued, the purpose of the money raised, and the time period that you're using those funds. So, again, you have to be very careful in terms of applying those conditions carefully. EIS has been around a lot longer than CDIS, and that's for typically slightly more mature businesses, and you get slightly less income tax relief of 30%, but you get the capital gains tax reliefs, capital gains tax exemptions on growth in value, and you get the deferral relief. And VCTs, venture capital trusts, typically it's a collection of investments that the venture capital trust has in EIS qualifying companies. So these are really the reason why equity investments are particularly interesting from a tax perspective. Even if they do not qualify for venture capital schemes, there is an investors relief which was introduced by George Osborne a few years ago. It's the opposite of entrepreneurs relief. You can't be an officer or employee, and I don't think you need to have 5% of the share capital in a business, but you can get a 10% rate of capital gains tax. So again, it's a useful relief to think about. Now, one of the things that you do have to be careful with an equity investment is the impact on entrepreneurs relief, business asset disposal relief, as you're potentially going to be diluted down, or there might be different classes of shares, and because of those rights in relation to those shares, you lose the entitlement of having your 10% rate of capital gains tax as a business owner. And again, if a business is not successful, then typically the investor gets capital losses, but there is also a share loss relief on CDIS and EIS. So for the amount they haven't received income tax relief, they can then claim a loss, and they can offset that loss against income tax. Now, so far what I've covered is really individuals. Companies making investments have a separate relief called the substantial shareholding exemption. So if a corporate investor comes in and has 10% of the shares, when they dispose of those shares, there's no chargeable gain subject to corporation tax. But on the flip side, if it's loss making, then it's not an allowable loss. So these are the things to really think about when looking for finance when it comes to a business. I think the other things that I will focus on are what you can do in terms of value drivers. I think Philip mentioned about the Great Resignation, and there is a lot of tools available from a tax perspective to really tie in employees. Ideally, there's been a lot of studies where if employees do have a skin in the game and they have an equity stake in the business, then it actually helps with growth. And it makes it very hard for them to leave as well. So really, there are two avenues. You could gift the shares, but if it's a profitable business, then those shares are worth something and they are taxed as earnings, possibly NIC. So what you can do is maybe sort of set up a different class of shares and they're entitled to future growth. So on day one, those shares are not worth anything, but in the future, as the business grows, that class of shares will have an entitlement to future rights to capital on a sale, and they'll get capital gains tax. Another area that people are always looking at is share options, and especially things like enterprise management incentives. Those ones, the principle is that you receive shares at a later date based on their current value, and that growth in value is subject to capital gains tax. And on the EMI, if you exercise your shares and sell them at least 2 years after grant, then those individuals are entitled to business asset disposal relief and a 10% rate of capital gains tax. So really a very good way of really recruiting, retaining and rewarding key employees. And if they leave, there are various things you can do with bad legal provisions or just lose out on the share options. So again, there is a motivation for them to stay with the business. And on a recent transaction as well, we helped clients from an MBO and then to sale. They put EMIs in place. Companies do actually get a deduction on the difference between the amounts that the value of exercise and the price paid by the employees, and that is given as a deduction for corporation tax purposes on exercise. So again, there are benefits to the company rather than possibly paying a bonus or more of a short-term remuneration package. Now, in terms of R&D, I think probably a lot of people are very well versed. It's something that's been around for many years. If you're coming up with a new product, process or software and it's advancing science and technology in that field, then certainly worth having a conversation whether you're eligible for R&D tax relief, because the reliefs are quite significant. You get an enhanced deduction of 230% on qualifying expenditure. So if you spend £100,000 qualifying expenditure, you get £230,000 deduction in your tax computation. And that's going to become particularly relevant when we jump to 25%. If companies are loss-making, that can be surrendered, that 230% can be surrendered at 14.5%. So again, using the same example, £230,000 at 14.5% should equate to £33,350. So it's effectively a 33.35% cash back from HMRC. And then there's a separate R&D expenditure credit for larger companies or those who got qualified for the SME, and the net benefit of that is 10.53%. So in the example of the £100,000, you still would get £10,530 back. Now, hopefully the R&D has been very helpful, and you're able to patent your invention. That is particularly helpful because you might be eligible for the patent box regime and you get a reduced rate of 10% of corporation tax, and that's given as a deduction to get you to that effective tax rate. So when we go up to 25%, we're going to have effectively a deduction which will reduce the tax down to 10%, and definitely worth thinking about. Other things to think about is capital expenditure that was touched on earlier. There are various tax reliefs. You can't claim depreciation, but then there are separate tax allowances called capital allowances. What is eligible or not for capital allowances is quite complicated. It's based on various case law, but typically as a rule of thumb, if it's performing a function in your business, then you can claim capital allowances. If it's part of the setting, then you might still get some allowances, but they're not as beneficial. Those allowances were introduced recently. So let's say you've got plant and machinery, you're eligible for the super deduction of 130%. That's on new plant and machinery, not cars, and that is around until 31st of March 2023. Now, interestingly, when you do 133%, 130%. The current rate of corporation tax is 19%. The benefit is 24.5%, which is very similar to the rate of corporation tax we're expecting to see. And the reason they introduced that was to encourage capital expenditure before the rate rises and making sure people didn't defer those. Now, there is a review into the capital allowances regime. So I think any spending that you are planning is definitely worth thinking about now. And the annual investment allowance, which gives you 100% relief, again, it's currently £1 million, but that's until 31st of March 2023, and the plan is for it to reduce to £500,000. So it'll be interesting to see what happens in the next budget. In terms of tax losses, that's again something that people forget. You might have made losses for a number of years, possibly due to COVID, especially with corporation tax rate rises. Hopefully, as profits are being generated, then those tax losses will become useful to you. And those also will possibly carry on with a future owner, although having been on both sides of transactions, typically as a buyer, you'd say, well, actually, that's great that you've got losses, but what we'll do is we'll manage the tax position as part of the buyer's group. And then you'll do whatever you can as a buyer to make use of those losses, but they typically attribute any value in a transaction. So there is a lot of things to think about in terms of losses as well. So these are the things that you can think about in terms of short to medium term, in terms of growth. I think that really the plan for a lot of people is the long-term plan on planning for their exit. And there's a lot of things to think about what an exit might look like. It could be an asset sale or share sale. You do have to be careful, because if it's an asset sale, then potentially you've got a double tax charge. First of all, corporation tax 25%, and then possibly having to take the net proceeds after corporation tax out of the company, so potentially income tax. And this might arise because you might have lots of different things going in the company, and the buyer is not interested in buying other assets, other trades. So again, tax structuring is quite important, and getting that right early on is key, because ideally you want to sell your shares and get access to business asset disposal relief. And effectively, you also need to think about what type of proceeds you're going to have. Is it going to be cash, ideally, on day one? Is there going to be an element of deferred cash? Is there going to be an earn-out? Is there going to be a form of paper consideration by way of a loan note, which is effectively an IOU? Or are you going to have shares in the buyer? And all of those will have quite significant tax implications, and will have access to various reliefs. I mean, this is a very quick run through what happens on the sale of the business. We do quite a few events on business exits, which I'm sure we can put you on the mailing list if you're interested in finding out more. So hopefully that was a helpful session in terms of tax rates, inflation, and also what you can do in terms of as a business owner, in terms of in the short term, medium term, and also thinking about the potential exit. Thank you.
Excellent. Thanks, Jan, and thanks to our other presenters for those interesting presentations. We're going to quickly move into the Q&A now. I've got some questions that have appeared in the Q&A portal, so I'll just crack on with those. Philip, to you, what is the current transaction activity level in the market, and are deals still happening?
Answer to those questions: yes, there are lots of deals still happening, lots of activity ongoing, certainly from a regional M&A perspective, and certainly what we're seeing boots on the ground at PEM Corporate Finance in Cambridge, albeit a focus on the East Anglian and London market. Lots of deals happening. I think vendors are suffering with a degree of fatigue, having traded through austerity measures and survived the pandemic. I think they're now quite keen to realize their investment and get a return on their sort of life's work, as it were, certainly the market that we're focused on. So yeah, lots of activity, and it's keeping us busy, that's for sure.
Good to hear, good to hear. Charles, to you, are private equity houses still having to outbid trade buyers on deals, or have valuations now stabilized?
It's a good question. It's one of those things that always varies. Depending on where we are in the economy, private equity is the best bidder. Other times they're very much the worst. I think given the amount of dry powder that I touched on earlier, most private equity houses, I would say, are comparable to trade, but it would be untrue to say that that's across all assets. If private equity likes something, they can bid very closely, and I've participated in a few processes where we've bid equal to or more than the trade equivalent in order to sort of acquire an asset. On the other hand, we've been outbid by like 100% on other assets, and that is not just Foresight, that is private equity as a whole. Might bid, a strong sort of 7 to 8 times for a great, it was actually a regional business that I think eventually sold for sort of 13 to 14 times. And there are always instances whereby a strategic trade buyer will place way more value, both financially and throughout the supply chain, the brand and whatever, on a business, and private equity just won't be able to compete with that because they won't be able to realize the exit. So in summary, I think yes, and just to elaborate a bit more on what Phil said, we are just as busy with regards to opportunities coming in, and business owners are looking to realize their investments, and valuations therefore remain high, and private equity has money that's able to pay those high valuations.
Thank you. And finally, just a quick response from you, Jan. How likely is it that Chancellor Rishi Sunak will abolish business asset disposal relief, otherwise known as entrepreneurs relief?
And you're on mute.
I would be very surprised if there was any changes to business asset disposal relief. I mean, it's already been reduced from £10 million to £1 million. And I think we've seen the impact of fiscal drag. So I think, it's £1 million at 10%. We're talking about the benefit of £100,000. I think really at the moment, the pressure is on the corporation tax. I think I was looking at the papers this morning, and they were sort of saying that a lot of people are trying to do a U-turn on the corporation tax rate. So there's a lot of pressure on Boris and Rishi Sunak to reduce the rate of corporation tax, because I think, as you can see, taxes are going up, and as a proportion of GDP, it's going to be the highest it's been for a very long time. So we're talking about 35%. So I would hope that certainly in terms of business taxes, we'll be seeing some changes to really help push growth.
Cheers, Jan. Thanks for that. So I think let's say now it's almost 1 o'clock, so now's the time to wrap up. So thanks to everyone for attending the webinar today. If anything else comes to mind sort of post-event, we'll be circulating a summary and some contact details. So look out for that in your emails. But say otherwise, nothing else to say now apart from say thank you for joining us and goodbye.